battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past 44 years, it's been our family's mission to deliver both clarity and confidence to help secure your financial future. Here we are, episode 195, quickly approaching episode 200. If you haven't registered for the live episode 200 taping at Francesca's Restaurant, downtown Naperville, make sure you do so. It's filling up very quickly. It's Tuesday, August 26th. We're going to have food and drinks and a special gift for every guest who attends. And we just want to say thank you to all of our listeners who have been with us since the very beginning. We started this about 5 years ago now during COVID and just never stopped. So thank you for coming back each and every week. And don't forget to register for Investor Day. That thing is filling up faster than I even thought it would. About 90 people signed up, and we only have capacity for 130 this year. So we are quickly approaching max capacity on Investor Day. That's our big investment conference in Oak Brook, October 16th and 17th. Don't forget to register. We're going to link the events in the comments section on YouTube. So if you're watching here on YouTube, all you have to do is click on the registration link in the description of the video, and then you can sign up directly. But let's jump right into it. Here we are today. Are we due for a correction? I think absolutely we are. Now, as you know, we don't try to read a crystal ball here at Stenger Family Office. We don't try to time it and get in and get out. We're never going to be the group that's going to tell you exactly when the bottom is in and exactly when to buy and exactly when to sell or anything like that. Now, when the market goes down, I have told you in the past, this is a great time to be buying. And when the S&P was sub 5,000 points, I said, buy, like there's no tomorrow. And every single time you see the S&P go down like that, we were at 6,000, 6,100 points. When you go down 20% like that or more, there are always people on TV or everywhere you look that are going to say it's only going to get worse from here. And I always like to tell you, no, that's not true in the long run. In the short run, maybe some of those people are right. And you may not be able to catch the bottom exactly. When the S&P was 5,500 points, I still said it was a good buy. But I think ultimately, when it got to 5,000, it was an absolute no-brainer. Now, all that to say, you may not pick it up perfectly on the downside, but every time the market goes down, it is a buying opportunity. In fact, that's never not been true, a double negative. It's always been true that the market going down is a buying signal. Over the long run, if you've got the right time horizon, you're going to be okay. And I do think today we have gone up a lot all at once, and we've rallied off the lows of April. I think April 7th was basically the market bottom. And remember, all these Wall Street pundits and strategists who said the market was going to rip ahead to 7,000 this year, cut their targets to 5,200. Stenger Family Office never did that. We said 6,700. We said directionally that's where we think we'd end up, and we never cut our estimates. Well, today the S&P is at 6,300, and it's only July, so we've got a ways to go. We still got 5 solid months here of 2025 left to go, and I still think directionally the S&P is headed in that way. Now, we could be wrong. Maybe we don't hit it exactly December 31st of 2025 to a T, but I do think that's where the market's going in pretty short order. I just look at earnings estimates. Now, all that to say, it doesn't change the fact that you could have a small pullback in the short term. We've only had about a 3% pullback now since we've rallied off the April 7th low. And you're probably going to see another 4 or 5% here at some point later this year. Don't let that spook you, because remember what I said, when the market was down 20%, you had these people saying it was only going to get worse and this is just the beginning of the end. Well, they're going to say the same thing when the market's down 4 or 5%, but none of them have track records. None of them actually have to publish what they've done long term and how wrong they've been, because if they did, people would tar and feather them and carry them out of town and exile them. Okay, well, you can't be bearish on Monday and bullish on Friday if you actually manage a portfolio. And so anybody who manages an equity portfolio like we do here at Stenger Family Office, and by the way, there's people at all these great companies on Wall Street that also manage money, and their equity portfolio managers for the most part have been spot on. And if you look at 200 years of market history, the one way to be in the stock market was to be bullish. Now, I've got people who have reached out to me and said, Nick, you are so off. I mean, yeah, I can't believe how off you are on this. And don't you see the world's going to come to an end, and U.S. Debt is going to catch up with us, and we're going to have all these problems. And look, I share all their frustrations. I share their concerns. I understand where they're coming from. And especially on the conservative side of things, where people are worried about how large the size of the federal government is getting, how much debt we're having, which, by the way, shouldn't really be a conservative thing. It should just be a bipartisan. Everybody in the country should worry about that stuff. Yes, I am worried about all those things too. But at the same time, I believe in the resiliency of the American economy, which is powered forward despite a lot of bad things. Now, the consumer is in great shape still. I'm not saying every consumer. I'm not saying every single person in the country is doing well. And that's unfortunate. That's very sad. And that's a function of big government. The bigger and bigger government gets, the more and more dollars we print, we crush the middle class. In fact, you saw this happen when we abandoned the gold standard. Inflation ran off, and it's just never been the same. Now, that doesn't mean that you're going to fall apart yourself as a household, but you got to have assets. You have to have money in real estate, and you got to have money in stocks, and you got to have money in things that are going to keep pace with inflation. And no better case of this than COVID. Now, we've seen 2-3% inflation prints annualized over history, but the past 5 years with COVID, we have never seen this much money printed, at least not since the 70s. And so it was a lot of inflation all at once. I think the worst of it's behind us. I do think we're going to continue to see these 2-3% prints. And I do think the Fed is a little bit high on their interest rates. I don't agree completely with Kevin Hassett, who says we're a 1.5% difference of where we should be on interest rates. I think that's ridiculous. But I do think 0.5%. And you've seen this also with mortgage spreads. Mortgages have way blown out. Mortgages probably are about 1.5 higher than they should be relative to history. But I think when you look at the Fed funds rate, I think that is about 0.5% higher than where it really should be. So if we can get about 0.5% interest rate relief, it's going to be interesting, in my opinion, to see what happens. A lot of people think you see this wave of inflation come back. It could actually be the opposite. You have a lot of people sitting on 2-3% mortgages right now that just don't want to move. And so that's really hurt the housing market, especially if you look at the Midwest and some parts of the Northeast, because people just can't afford to leave their 2.5 or 3% mortgage. There's some wisdom out there that would suggest that if you can cut rates a little bit, all of a sudden now it opens up the floodgates for the housing market. Could hurt housing prices in the short term. But remember, that's after coming off of 5 years of just outsized growth in housing. And so I think that's going to be really, really important. Now, the other thing that people aren't talking about too is long-term, the drivers of the bull market. And I won't go through them and bore you with it again today. I've done this a few times on the show. We are going to go through it at Investor Day in depth. But remember, one of the big drivers, one of the three, is millennials. And if you look at what's going to happen here the next 5, 10, 15, 20, 25 years. So this is a structural long-term trend. I don't think it's going away overnight. It's not going to be disrupted by Congress, and I don't think it's going to be disrupted by geopolitical events or anything like that, is the passing down of the most amount of wealth we've ever seen in U.S. history. Now, in my experience, we've been doing this a long time at Stenger Family Office. We've got 4 generations of the same family who still work with us, and we've seen this play out where somebody receives an inheritance, and what do? They go spend money. And I think you're going to continue to see this play out. This is a long-term structural trend. As you see this play out, you're going to see more and more luxurious goods spending. You're going to see more and more housing spending. You're going to see more travel. You're going to see more services. The service economy is booming. You're going to see a rise in need for more robotics and machine learning and cloud computing. And most companies, as I continue to remind you, have just barely scratched the surface on what AI can do, what machine learning can do, what robotics can do. They are just barely at the early innings of this technological wave that's coming. And not every piece of it is perfect. There are some companies that are in a massive bubble right now. In fact, I would say there's pieces of the AI bubble that are more overvalued today than the tech bubble was in the 90s. Remember, the entire S&P 500 in the 90s was trading for about a 44 PE ratio. Well, today we're nowhere close to that. We're about a 21, 22 P ratio. And the NASDAQ back then was trading for a couple hundred times earnings in some cases, in some years. And we're still not anywhere close to that in the NASDAQ today. But you are seeing that in pockets of AI. So if you are a new company, you're a startup, and just because you wanted to get some marketing attention, you put .ai at the end of your name, does not mean you're going to survive, doesn't mean you're a good investment. And I've seen this trend a million times. And one of them was the clean energy wave during 2020 and 2021. You saw companies like Plug Power and all these companies go to the moon. And the meme stock craze, we saw that was a big deal. You saw some of these home builder stocks as of craze during '08 and '09. You saw all these different bubbles throughout history. Well, certainly there are pieces of AI that are in a similar bubble today. So we've just been extremely, extremely selective and careful at Stenger Family Office within the portfolio. And we've said buy quality, buy companies that actually make money. Now, it might not be the most interesting investment. They might not be the racehorse stock that goes up 35, 40% a year every single year. But if you can find a company that's got a legacy business model that's doing well, that can cut some costs, that can use some technology, pay a dividend, and do a stock buyback, what's wrong with that? And those are the blue chip stocks you want to own for the long run. If you can own these companies 10, 12, 15, 20 years, these are generational stocks that we see our clients passing down, over 2-3 generations sometimes. And that's how you build lasting wealth in the stock market. It's not just chasing the new craze. And who knows here what will happen with Bitcoin and stable coins and all this other stuff that's out there. I'm not smart enough to make a judgment long term on where all this is headed. But I would guess that some of that's in a bubble too. And so what I like to do is I go back to cash flows. I say, what does a company make in earnings? And what does it trade for? Because I want to find a good company that's profitable, that makes some cash flow, has a high return on equity, high return on assets, and I want to hold it over time and not pay too much for it. Because Warren Buffett taught us all, you can find the best company ever, best story, makes a lot of sense. But if you overpay for its profits, it's really hard to make money on that stock over time. In the short run, yes, momentum is going to drive the stock market. And there's a piece of our portfolio that we have tied to momentum, is what it's called in the markets. And so when you got a company like NVIDIA that's just trending upwards, that momentum can continue for a long time. And by the way, NVIDIA's got strong fundamentals too. I actually pulled up the most recent earnings announcement. They're going to come out again here pretty soon in August and have another announcement for us. But this was from their first quarter report ending April 27th. And their revenue was $44 billion, still at a 60% gross margin, and producing about $19 billion, if you can believe it, in profit. And so that's absolutely incredible. When you look at where they were about a year ago at this time, they were at $26 billion in revenue, and they've just had a incredible run here, especially the past 12 months, up 70% year over year on their revenue. Okay, and so you're going to see companies like NVIDIA continue to produce numbers like this. And do you want to have everything in your portfolio on them? No, of course not. But these are the companies that are driving the next wave of innovation. Now, beyond NVIDIA, beyond some of the more advanced technologies, I keep telling you, half of these companies aren't even really on the cloud yet. They've got on-premise data centers, they've got on-premise softwares, they've got a lot of hardware that they still run, and a lot of these companies haven't even moved into the cloud. That's a booming industry right now. And I look at that and I say, who's that good for? That's good for Google, it's good for Amazon, it's good for Microsoft. I'm not telling you to go buy any of these companies. None of this is individual investment advice. But what I am telling you is there's a lot of truth, there's a lot of power, there's a lot of fundamental reality behind these companies. It's not the Fugazi of the 1990s. It's just not. This is not Pets.com. This is not companies that don't have any profit. This is not companies that trade for 500 times earnings. Yes, there is some of that in the S&P. Yes, there are companies like that, especially in the NASDAQ right now, but it's not the bulk of it. And so that's why I think, yes, we're due for a short-term correction. You're going to have something that comes out, some story, some doom and gloom article, and it's going to produce a 3 to 5% correction. And what are you going to do if you're on your long-term plan? You're going to either ignore it, or number two, if you got some cash, you're going to buy buy. And if you're still working, if you're in your 401k at work, you're happy about that because that's the time to buy cheaper. And so that's what I would recommend you do during these times is just be prepared mentally for the correction, but don't do anything different in your portfolio other than stay on your goals-based plan. Now, what does the goals-based plan look like? Well, I would say if you're in your 20s and 30s, you should be heavy equities. And there's almost no reason to own bonds if you're in your 20s and 30s, especially when we're talking about your retirement accounts. I see more and more people that are millennials, even younger than millennials, who are just completely scared out of their mind of the stock market. They just can't imagine any risk. They can't accept any volatility. And they own actually more cash and bonds in some cases than some of our baby boomer clients. I always ask myself, why is that? Well, it's probably because they just haven't been through it before. They haven't lived long enough to see some of these corrections like 87 and 99 and 08 and 09 and Brexit and Grexit and COVID and all these different things that we've been through, and they haven't lived long enough to see the market come back. Well, I look at our baby boomer clients, I look at people who are pre-retirees, I say, hey, if you're going to retire pretty soon, let's have some money in safe money. Let's get you through a period of 3 to 4 years in case there's a downturn. But everything else, in most cases, you could put in blue chip U.S. companies in equities, and you're going to survive over time just fine. Because when you look out 5 years, 6 years, you're going to have about a 92% chance in any rolling time frame we've ever looked at the past 200 years that equities are up. And if you look at a 10-year rolling time frame, any time in history, any 10 years that you want to pick at random, there's never been a time ever that equities haven't produced a positive return. You cannot say that for bonds. You cannot say that for cash, especially when adjusting for inflation. And so that's why I continue to tell you, have a goals-based plan that's going to account for some of the volatility. It's going to protect you on the downside, but at the same time, it's got enough mathematically that's going to grow and beat inflation. The entire retirement equation, the entire portfolio is literally just math. If you're sitting there in 30% safe money and you've got 70% in equities, well, your statistic mathematically, it's not rocket science. You're only going to pick up 70% of the upside. And if you do that in retirement, let's say you got a 60-40, say, Nick, I've always heard my entire life I got to be 60-40, nice and safe and secure when I hit 60 or 65 years old. Well, be careful because you still got a time horizon ahead of you that could include and probably will include a lot of inflation. So that's why I say be in equities. Think of yourself as a private equity owner. Think of yourself as a small business owner when you buy these companies. And so let's say you had this hardware company that you owned and you happen to be very successful and your hardware company one day is worth $5 million. One day it's worth $3 million. Maybe the next day it's worth $10 million, but it's producing $2-3 million a year in cash flows. And you're saying to yourself, why would I ever sell my hardware company that's producing $2 million a year in cash flow? Doesn't matter what somebody offers me for it. Somebody offers me, 10, 5, 3. I'm going to just hold my hardware store. I'm going to own this company forever because it produces cash flow, pays my bills. Well, think about Home Depot in the same way. If you own Home Depot, it's just a big scale version of that. And then you think about your company that makes phones, and that's Apple. And you think about your company that makes consumer products, and that's Procter and Gamble. And again, they're going to go up and down, and they're going to have some big bad years where your heart drops and you think the world's coming to an end, and you never think the stock will ever come back, and then it does. And so in most cases, if you're diversified, if you got a basket of 40 or 50 companies, you're going to have 2 or 3 stocks that are down. You can't avoid that. That's part of being in the market. But you're going to have a lot of stocks, especially if they're high quality, that are up. And that's our job. Our job is to put that portfolio together for you to beat inflation over the long run. So yes, we're due for a correction. I don't know when it's going to be. I don't have the crystal ball. I can't pinpoint the exact date and time. Just be prepared for it. We're gonna see some volatility, and I think ultimately we're still going to head towards that 6,700 point target that we set out at the beginning of 2023. Whether it's the end of this year, the beginning of next year, we're going to get there because the S&P now is expected to do $340 in earnings for 2027. And so when you start seeing earnings numbers like that, I think it's just a matter of time before you're going to take the S&P, you're going to multiply by 340 by about 20, and then ultimately you're going to go up probably another 6 or 7% on earnings estimates after that. Maybe you trade the market a little bit hotter at 21 or 22 times if the Fed cuts. And so it's not out of the ordinary. It wouldn't surprise me at all if we are trading the S&P at 7,000, 7,200, 7,300 in the next 18, 24 months. And if you look at where we're at today, let's say we get to 7,300 on the S&P, we're at 6,300 a day. You throw the dividend on top of that, you're looking at almost a 20% total return. So who cares what happens tomorrow? Who cares what happens a week from today? Just stay invested. If you want to see those long-range higher returns, if you want to see long-range equity returns at 10% annualized per year, then just stay on your plan. You got no business panicking. You are not going to be able to trade it. You are not going to be able to time it. And I continue to remind you, you don't know what the future holds. You don't know what great news is going to come out. You don't know how good technology is going to be. You don't know how companies are going to use it. You don't know how companies are going to have this propensity to beat their earnings estimates. So just stay invested. Thank you so much for being here. Episode 195. We're going to see you next time, 196. In the meantime, don't forget to register. We're almost full here on episode 200. We're going to link it here on YouTube in the description. And then come back October 16th and 17th for Investor Day. Thanks for being on. We'll see you next time.